Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 227th VideoCast podcast for the week ending February 22nd, 2024. As always, we'll kick it off with some family updates, and then we'll get down to business. Lots to cover in the markets this week. This weekend, we were at Yale. Mimi and Annabelle were in a meet. That's my three girls, Mimi, Annabelle, and Caitlin, of course. And so basically, as Caitlin wrote for me, it was a Freaky Friday switch for Mimi and Annabelle. Mimi, our distance freestyler, swam epic backstroke, putting her in Connecticut top 16. And Annabelle, our backstroke phenom, swam distance freestyle and almost broke 6 minutes in the 500 free. So great job all around there. Someone asked me last week, they heard the dogs barking, so they wanted to meet the dogs. That is Lucky, and that is Pepper. So great dogs, and that's that. Those of you who are new, I know we have a lot of brand new people listening in this week, so welcome, welcome, welcome. So if you don't get to see, I usually like to give a behind-the-scenes look when I do some of these media appearances. This is the green room for the Charles Payne show I did earlier this week. So it's pretty cool. And then this chart we're going to go into in just a minute. So first and foremost, want to thank Charles Payne, Nick Palazzo, and Kayla Arestivo for having me on Fox Business, the Claim and Count, Fox Business Making Money with Charles Payne this week. We're going to go ahead and listen in here as I talk about how we think about selling positions, how we think about hedging, and then some detail on two positions we've discussed, and we'll go into further granular detail. Great interview. Listen in.
Market goes down. Now, the question is, what do you do with your portfolio in those periods? Right? According to Stock Market Almanac, in fact, what we ventured into right here, you see the purple line? This is where we're going right now. We're pulling back a little bit. Now, here's the good news. This is when we have all these sort of typical election seasons. One thing is that the green line, when you have a sitting president, you usually go down, and then we start to turn up, and then we take off like a rocket ship. There's a lot of theories for that. A lot of money pours into the economy when the incumbent's trying to stay in office, those kind of things. I want to bring in now Great Hill Capital Chairman Thomas Hayes. And Thomas, you're expecting some near-term weakness right now.
Yeah, that's right. And as you know, I've been coming on the show for a year and a half, bullish every single time.
Right.
So this is new for us. We actually put on a tactical short last week. We started on Tuesday. Then the market kind of crapped out after the CPI numbers, and we finished it on Thursday when the market recovered. So we have 1% of equity capital in near-term put spreads in case we get this 5 to 7%.
Is it to make
pullback.
money, or is it just as an insurance policy?
Dampen volatility. If we're right, we'll have extra capital to go long into year end. If we're wrong, it's 1% of equity capital. But the key is we don't have to sell out our positions that are not at full value so that we don't create taxable events.
All right, so, okay, I'm glad let's talk about that, because you actually wrote about why you hold into these dips, why
Correct.
you want to hold these positions, right? You want, and some of the things, if you own a quality business, then you stick with it, right?
Correct.
Stocks go up and down.
Yeah.
If you believe in a business and you think it's a quality business, don't be so tethered to the share price on
That's
a day-to-day
right.
basis.
That's right.
Avoid a taxable event.
Yeah.
I've seen people do this and mess up. Like, in other words, they didn't want to pay, the tax, so they held a great win, and they ended up losing on the win anyway. Like, it would have been better. At what point, what percentage gain is okay to say, okay, I'll pay Uncle Sam a piece of this?
Yeah, so before we go into a company, we have an estimate of what's fair value, what's fully valued. So if they've not reached those events, we're going to hold through that short-term volatility, and we may hedge tactically just to dampen volatility and create excess capital.
But let's say you bought something at $30 and it's $50 now.
Yeah.
And it's starting to spin its wheels a little bit.
Yeah.
I mean, and you've held it for 6 months or a year.
So here's what we did with Intel last year. We bought Intel at about $25.10. It went straight up to 48. We took off 2/3 of that because the legacy PC business and the data server business was fully valued, and we kept 1/3 of those profits on just on.
So the taxes had nothing to do with it then?
That's correct.
It was all mostly
Fully
based
valued.
on the fundamentals being fully recognized in the share price.
That's right.
You see a strong year in rally. You've mentioned that. Also, earnings estimates are going up. Let's talk specifics now. because I like when you bring these specific names.
Yeah.
All right, this is my theory, okay?
Yeah.
Baxter, okay, we've got this trend line.
Yeah.
We're breaking through the trend line here.
Yeah.
Now, if I was doing this, if I was doing it, I would have something under the last low as my stop loss.
Yeah. Yeah.
Is that what you're doing? I know you like this fundamentally more than technically. Though,
Yeah,
right?
so I came on December 12th with this name. It's up about 10% and change since then. The key thesis here is that the stock is trading at 12 times forward earnings. The reason it's trading is because growth has slowed down due to the kidney business. That's the slowest part of the business. They're spinning that out to shareholders.
Right.
Before the summer, which means we could get a multiple re-rating because what's left of the business is going to re-rate to its historic multiple, which is closer to 18 times.
Still, though, Canada Goose is another name. And, I mean, listen, it feels still like, okay, you like it fundamentally. You probably liked it fundamentally for a while.
No, we came on.
Just here recently.
Actually, in January, it's up 12%.
Is that when you liked it then?
That's correct. Yeah.
Breaking out, though, does that give you even more confidence, breaking this long-term trend line?
There's no question technicals play a factor, but the key is they crushed earnings and they increased their guidance. China was up 62% year on year. They love these luxury jackets. What they're doing is they're moving their
What
business.
happened then, because we got 30 seconds. What happened from here, though?
They had inventory problems, okay, major inventory problems. They over-inventoried with COVID, not dissimilar to Intel, by the way, not dissimilar to Baxter. All these companies, not dissimilar to Generac. They all over-inventoried due to COVID because they couldn't get product, then they got too much product, and they had to work that through over 6-7 quarters. These are now troughing, and you're seeing sales grow, margins grow, cash flow grow, and this business is going to recover nicely.
Great stuff.
Hey, thanks so much.
Oh, man, great seeing you. All right, coming up, my next guest says is trying to reverse 100 years of history, and he's doing it by helping low-income families. Damon Harris is going to join us with this story from West Richmond, Virginia, next. All right.
And we're back. And then I want to thank Aaron Bry for having me on Benzinga earlier this week. And I got a lot of tremendously positive feedback. Aaron asked a lot of questions. And the beauty of these free-form interviews is basically like going acoustic on a guitar. You can really get into some granular detail that you can't do in a 4 or 5 or 6 minute segment. And it gives people a lot of educational value. So we're going to tune in here.
But all right, it is almost 11:15. I see my man Thomas Hayes hanging out backstage. So without further ado, let's go ahead and give Thomas our very special Zinger Nation welcome. When we come back, we'll see what Thomas thinks on the market right now. See maybe if he'd be buying the dip on some of these chip stocks, and as well as some other trade ideas. All right, welcome Thomas Hayes back to Benzinga Live. Thanks again for hopping on with us today. How you doing?
I'm doing great. Thanks for having me, Aaron.
Of course. So give me just your top of mind, like overall market outlook right now. I know you were bullish for a while when, a lot of people weren't bullish on the market. Do you still have that same mentality, or do you still have that positive of an outlook on the market right now?
Yeah, well, Aaron, it certainly was lonely. October 22 and even October 23, everyone got bearish as well. And there were a lot of major names that have since either flipped bullish or found new jobs. And when you see those kind of last holdout bears flip bullish, it can be reason for pause in the short term. I think generally looking out, we're very, very constructive, but I think we're moving into a period, as a lot of people know, generally on a monthly basis, seasonally, the end of February tends to be weak. There's no real catalyst. Earnings season's winding down. Earnings season was much better than expected. 2.9% earnings growth versus 1% earnings growth expectations. So you have some seasonal weakness. And then in an election year, this tends to be the period where you get weakness in February and in March. The only thing that worries me about being short-term cautious and long-term constructive is that quite a lot of people are looking for this 5 to 7% pullback in the next couple of months between now and April. To position for that, last week we put on a hedge for the portfolio. We did some short-term dated put spreads on the S&P. And the reason we did that is a fewfold. First and foremost, we don't want to sell any positions in our portfolio. So we're long and strong because there isn't a position in our portfolio that we believe has reached full intrinsic value. We know where we want to get out of a company before we even get in, and none of them have hit those levels. There were a couple we could have considered selling calls against, but I don't like that. If it gets called away, you get a taxable event. So we wanted a situation where we could dampen volatility for clients. And if we're right, that 1% of equity capital that we have as a hedge, the expected value is 5x. So that would become 5% equity capital. And that gives us a lot of money to add to be long into the end of the year, because on average in an election year, Aaron, since 1928, the S&P is up 11.28%. And we believe that's going to be the case this year. So very short term, February, March, April, maybe we get that 3 to 8% pullback. And that's why we have the 1% of equity capital as a hedge short. But I think through the year, if you just sit tight and did nothing, you're going to have a great year. Up 9, 11, 12% on the indices, and much more if you're doing a decent job picking stocks.
Got it. So in the short term, you're a little cautious, and you think we might see this pullback. But overall, if you then zoom out to the whole year, you're still pretty generally bullish.
Yeah, unequivocally.
Got it. And I do have, you were talking about how some of these bears are now flipping over to the bull side. And it's funny, too, how a lot of the perma bears, like, the bear case keeps changing, right? For a while, oh my God, rates are at 5%, and then rates are at 5%, and the economy is fine. And then it's, oh my God, then something else, and then this geopolitical thing. And it's like, hold on, if you're going to keep coming up with a different story of why the market's going to come down, then you're kind of losing me over there versus people that have like stuck to, this is why the market's going to be fine. And then, but I do have these numbers. And it's interesting. This is from the AAII, the American Association of Individual Investors, just the bullish versus bearish sentiment. And like you mentioned, October, November 2023, you can see right here, that was our 1-year bearish high on this rating, and it was over 50%. And that was just a few months ago, November. November 2023 was less than 4 months ago. Now it's almost completely flipped, and you have 42% of people that are bullish, and basically only half, 26.8% of those people that were bearish. So you've seen, a lot of bears now leave that camp.
Yeah, and I think the key thing here, Aaron, is we have to keep in mind, even though maybe we get this pullback, maybe we don't in the next few weeks, we've had 2 years of sideways consolidation, namely 0% gains. So we've just broken out of a 2-year consolidation. Very tough to get bearish in a meaningful way here. The trend is now resumed its uptrend. I think if you do get a pullback, maybe you come back to where it broke out at 4650, 4700 range, but not a whole lot more than that. And I'm happy to be wrong, because if the market keeps pushing higher, yes, we've burned 1% equity capital, but the beta and convexity in our portfolio, if the market's up another 4 or 5%, we're going to be up a lot more than that. So yes, we lost a net 1%. But if we're right, we get an extra 5% of capital to press into year end, which could add 10 points of alpha for our clients, which is very important to us. So I like the risk reward. I think what punishes the most people, we look at the pain trade a lot, would actually be neither, in the sense that we just grind sideways and burn everyone's premium, burn all the new bulls premium, burn all the perma bears premium, and grind sideways for 3 months, consolidate some more before we resume the uptrend. That's probably maximum pain for most participants right now.
That's interesting, because when you think about that maximum pain scenario, you're typically not thinking about just sideways trading. Maybe for like an options play into earnings, where it's like, okay, if Nvidia doesn't move much at all after its report, then obviously everyone buying calls and everyone buying puts are probably going to be down. But when I think about maximum pain scenario for the overall market, I'm rarely thinking about it just grinding sideways. So that's definitely an interesting kind of outlook there that I'll have to think about. Do you want to get into some of those individual names that you do like long term, and if you're
Yeah.
If your short works out, where are you going to put this extra capital?
Yeah, no, that makes perfect sense. So first, the other thing to keep in mind, by the way, one of the key metrics we look at is the Bank of America Global Fund Manager Survey every month, which came out a few days ago. Global managers are still 1/10 of one standard deviation below their long-term average in terms of equity overweight. So there's more, as much new optimism that's come into the market. There's still a lot of skepticism. The sentiment and the outlook among institutional managers that manage about $1 trillion in this survey has risen a lot, but it's not at extremes. So I think there's more work to do on that front, which is kind of the overriding arch. We've got a few picks. As you know, we're much longer term than most. Our average holding period is 12 to 48 months. When we buy a company, we buy it when it's out of favor but cash flow positive, usually growing cash flow, or temporarily impaired and is going to resume back to its long-term cycle. So we like to buy boring businesses. I know there's a lot of excitement around specific names. It's like a moth to a flame that people just can't not participate in. A couple of years ago it was Tesla. They either had to be perma bears saying that the cars fall apart or whatever, or perma bulls saying Musk is gonna everyone's gonna be driving an electric car in two months. So we generally stay away from stocks like this. So right now you got SMCI.
I assume no. I was gonna say I assume no SMCI then, or
no SMCI, no Nvidia. Obviously, NVIDIA is hitting on all cylinders. Great company, great business, great leadership, all of that stuff. For us, though, paying 40 times sales, in the short term, it can go to 80 times sales. We have no idea. But if you just look quantitatively at data over the last 100 years, buying anything at 40 times sales usually doesn't end well in the long term. In the short term, it doesn't mean you can't double or triple your money. But in the long term, the odds are against you, and we just tend to play with the odds. But there are always exceptions, right? So Bitcoin, we miss that. It's not what we do. We only buy cash generative assets, but our framework wouldn't allow us to participate in certain things, not because they're right or wrong or good or bad, just because we know what we're good at and we stay in our lane and we let people make money tons of other different ways that are good for them.
Got it. So, I know PayPal is one of the names that you said you like. I can go ahead and pull up a chart. The report a couple of weeks ago was not, I think, what a lot of bulls were looking for, but you're still, you still want to hold this company long term?
Yeah. I noticed on your profile, are you a golfer?
I am, yeah.
Okay, so I'm a golfer as well. So there's a phrase in golf called sandbagger. Yep. Which is, the kind of guy that never records his low scores, and he says he's a 15 and he goes out there and miraculously shoots a 74 and takes all your money. Basically what you had with Chris, Alex Chris, the new CEO, was he's basically just found the coffee machine. He's been in the business for 4 months. He came from Intuit rather. While he was at Intuit, he ran the small business division, which was responsible for 50% of the revenues. That stock was a 38 bagger over his tenure, running basically 50% of the business. Wow. And he came in and he saw what we see, which is a business that's generating about $5 billion a year in free cash flow. They're now buying back about $5 billion a year in stock. And he's a master of small businesses, which is what PayPal caters to. So he came in. He saw the opportunity, and he goes on with Faber on CNBC and says, I'm going to shock the world on January 26th. And he comes out with a pre-recorded 20-minute pitch on the 5 or 6 things that he's going to do, which probably will shock the world 12 to 24 months out as he implements them, and the margins start to reaccelerate, and the cash flow goes from $5 billion a year to $7 or $8 or $9 or $10 billion a year. And people say, wow, what happened so quickly? But it wasn't going to shock him in a 20-minute sleepy video. That's for damn sure. So he realized the stock went up into that. It sold off after that. And then earnings, he said, let's try the opposite tact. Instead of promising the world, let's promise them nothing. And then we can exceed expectations every single quarter moving forward. And that's exactly what he did. You have a company that beat revenues were up 9% year on year, earnings non-GAAP were up 19% year on year, total payment volume was up 15%. This is not a startup with total payment volume up 15% year on year. This is a company that has 10% of global enterprise spend. So people think of PayPal, they think about the PayPal button, on websites and everything else. The vast majority of the business is white label with Braintree. And so like when you take an Uber, people say, I haven't used PayPal in 6 months. Well, when's the last time you took an Uber? You used Braintree, which is owned by PayPal. You just didn't know it. Every time you take an Uber, PayPal and their owners get a cut.
Interesting. I did not know that.
Okay. PayPal, Booking, Ticketmaster. Have you ever gone to a concert in the last 12 months? That's Braintree. PayPal owns that. That's so 500 billion of 5 trillion global enterprise spend goes through Braintree, effectively PayPal owns that. And what analysts have been worried about was that when they made that acquisition, it brought the overall margins down, even though cash flow per share went up, revenues per share went up, earnings per share went out. It brought the gross margin down because you can't charge 3 points on Uber. They're not going to use you that you can charge 3 points on a small business guy with a website that's more than willing to pay 2.5 or 3 points because they have small volumes and they understand that that's it's easier to set up and easier to use and all that stuff. So the one thing that Chris alluded to on the previous earnings call, not this earnings call, was a margin inflection in Braintree. The minute you start to see that, and we did see margin expansion this quarter, but people were overwhelmed by the soft sandbagger guidance, you're going to start to see a re-rating. So to give you an idea what that means, Aaron, the stock is traded at 30 times earnings historically. That's its average earnings multiple. It's currently trading at 11 and a half times forward earnings estimates right now. And what you're going to see is that 510 winds up being 6 or 6.5, and margins start to expand. And not only do you go up because earnings go up, but you're going to go up on a re-rating as margins go up and earnings go up. So from 11 to 15 to 20. And at some point, we'll be back towards 30. People can't imagine that right now. But if you were at the average historical multiple today, you'd be a $150 stock. Never mind growth, never mind margin expansion, never mind all that stuff. So we think this can be an easy double over the next 12, 24, 36 months. And the market will figure it out later. But the name of the game is he set the stage. He set expectations extremely low right now. Market didn't like that, and he's going to crush it every single quarter. And this is the guy who, with the 15 handicap, winds up shooting 74. And you say, how did that happen? It's because he was never a 15. He always saw. He just set expectations very low.
Yeah. So if Chris was taking you out to golf and he told you he wanted 10 strokes, you'd be a little skeptical on the first tee.
Exactly. And that's basically what he had asked for. He said, give me 10 strokes. We're going to have 2024 is a transition year. I need 10 strokes. And then he's going to just knock it out of the park.
So, I mean, it must get, I don't want to say lonely, but like when because you're specifically targeting stocks that, like PayPal, are beaten down and out of favor. I mean, it's probably, feels like it's like when you were bullish in the overall market, when everyone else is bearish, everyone's probably like, oh, you want to touch this? PayPal's, awful. Look at the chart. It was just a COVID play and all this. I mean, what do you say to people, I guess, that are kind of, I guess, either like perma bears on PayPal?
Yeah, I love it. Look, if you didn't have this extreme of sentiment, you couldn't have outperformance over time. So if that sentiment didn't exist, I wouldn't be able to do what I do. All the companies I'm getting in. I have 2 filters when I enter a company. And we own PayPal in across most accounts are in the mid 50s, but it's immaterial whether you buy it at 70 or you buy it at 50. This thing is going to be double or triple. The key is that the filters we look at are number one is if this goes to 0, do they carry me out in a stretcher? And if the answer is yes, you either have it sized too large in your portfolio. Now, we run a concentrated book, 8 to 12 companies at any one point in time. So we do run concentration. But the expected return for the rest of our portfolio, if one company went to zero, we're still going to be able to outperform over 36, 48 months because the rest will pick up the slack with outperformance. The second filter in the case of PayPal is if we walked into the board of directors and offered to take the entire company private at the price that was quoted in the market today, would they call security to have us escorted out of the building because the offer was so ridiculous? And if the answer is yes, that hits our filter. So one, it can't take us out on a stretcher. And two, it can't be at a price where the board would actually entertain it. And right now, if you were to walk in and say you have financing from JP Morgan to take the entire company private, anywhere near today's prices, they would have you escorted out of the building. One, they'd be insulted. Two, they would think you were a lunatic. And three, they wouldn't even meet with you. They would say, get this schmuck out of the building. He has no idea what he's talking about. Because just on a cash flow multiple, I mean, they're going to generate another $5 billion of cash, buy in $5 billion of stock this year. There's nothing to think about. This thing in an LBO, the minimum you'd be able to even entertain would be $100 a share, minimum.
Got it. Which would put it at around $100 billion market cap. It's at 60, around 63 right now.
And by the way, if the board accepted an offer like that, they should all be taken around back and shot. I mean, it would be absolute theft from the shareholders.
Yeah, it's like when back in the day, someone tried to acquire Netflix and Reed Hastings said no. And I think it was Icon tried to come in and buy Netflix and they said no. And people were like, well, you have to. It's in the shareholders' best interest. And he's like, no, it's in the shareholders' best interest not to take this offer. So just because something would be a good, short-term return to the shareholders doesn't mean that necessarily that's the best outcome for the company in the long run.
100%.
What do you mind if I ask? Like, when did you enter a position in this?
Yeah, so across accounts, we have a lot in the mid 50s and some in the mid 60s. So blended basis, call it $60. I probably a little less than $60, but in that neighborhood.
Hey, so I could get in right now at a lower cost basis than you, and you've done all the research. I like that. That's it makes my job easy.
Exactly.
All right, Thomas, do you have any other individual stocks you want to chat about while I got you for a couple more minutes?
Yeah, we like Baxter. This is one that we entered in the mid 30s, 53% down off pandemic lows. It's another multiple D-rating that's going to be re-rated. It's historically traded at 18 times. It's trading at about 12.5 times forward. The reason it's trading is because the kidney renal care business is the slowest growth part. They're going to spin that out to shareholders before the summer, which means RemainCo is going to have a much higher growth rate and get back to its historic long-term average, call it 18 times, just on the re-rating. Plus, they are re-accelerating cash flow, margins, earnings since COVID. All these companies, they overstocked during COVID because they couldn't get product. They're a medical device company. Then they had to work through all that excess product over, call it 6 quarters, whether it's Intel, whether it's Generac, whether it's Stanley Black & Decker, whether it's Baxter. It's all the same story. Canada Goose, they're all the over inventoried, worked through. Now revenues, margins, earnings, cash flow, all re-accelerating, but people are still stuck in recency bias, looking in the rearview mirror, just like all the people were bearish at the bottom in October 2022 because they were stuck in recency bias, looking at the prices go down in the previous 5 months, and they missed the opportunity of a lifetime. Now the market's up 40 some odd percent, 45% off the lows, and now they're just starting to get interested. And we just have to suck those folks in, and that's when we get our 5 or 7% pullback to shake out the weak sisters, the new money, and then we can resume the uptrend. Because, as I said, after a 2-year consolidation, you don't want to get too cute when that's breaking out. Maybe we retest the breakout level, but we're constructive for the next foreseeable future.
Yeah, and of course it'll be we've got more rate decisions and stuff like that coming in the next month or so. So it'll be interesting to see, what's happening. Obviously, NVIDIA's earnings tomorrow after the close. That'll be a big one for the tech market. Because, if NVIDIA somehow, some way puts out like bad numbers, like they don't even meet the expectations, let alone, 'cause for me, not to, I know we're not talking about Nvidia that much, but if they don't put out a quarter that like blows the numbers out of the water, then I think you could still see a sell-off even on a beat. And so then if they don't beat at all, if they miss and then Nvidia's down 10%, and then, that trickles into Apple and Microsoft or whatever, we could get that pullback that people are looking for this week. But that's a big if, because I think, again, the market's expecting some good things out of Nvidia. So, all right, those are Tom's 2 picks for the day. You got PayPal, ticker PYPL, and Baxter, ticker BAX. I'll throw those in the chat if you guys want to go check them out. And again, you can look at all the fundamentals, the chart, what I'm doing right here on Benzinga Pro. So, Thomas, anything else you want to leave us with today?
Yeah, I mean, the only other company we've been spending some time on is Canada Goose. We've built some position at 11 and change. This is a luxury jacket retailer. And basically what happened is they got a problem in the wholesale channel. They've moved all of their production, or the majority of it, in-house. Same type of problem. They couldn't get product. They've worked through excess inventory over the last 6 quarters. They've got a 5-year plan to take it from $1.3 billion in revenues to $3 billion in revenues with 30% EBIT margin, which implies $6 to $7 a share earnings. They're running ahead of schedule. If you look at any of their stores, they're basically the Apple store of luxury jackets. This is a cash machine. It's family owned. It's been around for 50 years. Most people don't know that. The son is running it, owns 20% of the stock. He is executing, and I think it's going to surprise people now that everything's starting to inflect. And by the way, everyone's so bearish on China. Asia Pacific was up 62% in the most recent quarter that they just reported a few weeks ago. Largely driven by China. The Asians love these jackets, and North America and Europe is going to start to improve. Their gross margin has expanded by 15 points over the last 5 years. Their revenues have tripled over the last 5 years. Stocks down on those COVID-based inventory issues, which are now largely worked through. We think the stock can start to inflect. And with all these names for us, these are all 12 to 36 to 48 month plays. We're looking for doubles and multi-baggers. We're not looking to make 20% and get out. That's
my type of style. I like that.
Yeah. So that's how we think about it. So I think Canada Goose is one with a little more risk and a little more reward to keep on your radar.
Where you're out in New Jersey, right?
I live in Connecticut, and our business is based in New York City.
Got it. Okay, so you're in the Northeast. I'm sure you see a lot up here in Detroit in the winter when it gets real cold. You see a bunch of Canada Goose jackets around. I know a bunch of my buddies in Chicago. They got real tough winters there too. Wear them and actually say that, like, they're expensive, but you get what you pay for, in the sense that you're not going to be cold in them. The one, I guess, like, fear I have with stuff like this is I do know a lot of luxury right now is dealing with a lot of like counterfeits and fakes, and a lot of people are, maybe instead of buying a Chanel bag, they're buying what looks like a Chanel bag, but it's not. And there may be some of those for Canada Goose out there. But overall, I mean, because China's the big market for Canada Goose. Right?
China's the big market, and that's why they've ramped up their Apple stores of jack. Like, if you ever go into one of the Canada Goose stores,
we have one. We have one here, and
it's gorgeous, right?
Yeah.
I mean, it certainly is on Fifth Avenue in New York City, and it's literally like an Apple store. And there's lines outside, like you can't even get in, depending, if you're on the weekend or whatever. The Chinese don't like counterfeits.
Right.
The irony is they know
they come from China. Yeah.
They come from China. But so by lowering the low margin wholesale channel and increasing the direct to consumer, which is 70% gross margin business, all the Chinese want to buy Canada Goose jackets. They only want to buy them in the Canada Goose store, so they know that it's authentic and has that lifetime warranty. And that's where they're getting the growth, where the greatest demand is, and where people actually do not want to buy counterfeits.
So by almost in a proxy, like by buying Canada Goose where it's the stock's at now and it's, beaten up, and that's what you've been looking for, is beaten up names, you're kind of in a way like betting on the Chinese recovery.
100%. By the way, this is for the folks who are nervous about the China recovery. And we have a big position in China in Alibaba. we like that story here. But leaving that aside, for those of you who don't want to play directly because of all the different noise around China, this is an indirect play. So,
Right.
some people play it through Estee Lauder, some play it through Nike, and some play it through Starbucks, or different ways, kind of quote unquote safe ways. This is a more direct, leveraged way to play it for those who are amenable to a little bit of volatility, because it's a small cap name,
Right.
and it's going to take a little while to get the recovery hitting on all cylinders. But when it goes, it's going to go.
And is it one of those things where if you're looking at Canada Goose, you can be like, okay, well, even if China's economy continues to struggle over the next year, like this thing is not going to go much lower than it is right now?
Yeah, I mean, it's mind-boggling. If you laid out a chart of the cash flow per share, revenues per share, earnings per share, gross margin expansion, you'd just say, well, how is this stock even down? And how it's down is basically the rear view mirror inventory issues, which the market is struggling with believing are over. But if you actually go through the earnings calls and through the progression of the process and how the owner, the son of the founder, has been executing over the years, you would say there's something here and I should have a piece of this. And that's exactly the conclusion we came to after a lot of research. And we're patient. If it goes lower, we'll use the opportunity to add more. And if it goes higher, we're perfectly content with what we have.
Got it. Well, last question, Tom, and I'll let you get on because I know you're busy. But we've talked about now 3 stocks in very different sectors. Have you played like other retail names like Canada Goose before, or how do you pick between PayPal, a fintech play, a healthcare play, and then a retail play? I mean, all kind of you're basically looking across the board for anything that meets those filters.
Yeah, I'm looking for high quality businesses where the price, the short-term voting machine based on emotions, is at an extreme, and the long-term weighing machine, the fundamentals are actually either inflecting, bottomed, or starting to improve. In most cases, starting to improve. And when you look at the price relative to the positive fundamentals, the dislocation is so large. That's where you can get excess returns and excess alpha. Playing the time arbitrage game. So the name of the game with all of these is if you're not on leverage, you can wait till the price, just as it's so emotionally despondent with a contracted multiple on the downside, at some point, 12, 24, 36 months, when that flips, it's going to be so euphoric and optimistic, and the multiple is going to be higher than it should be. And that's when we start to lay it off. When it starts to price in more growth than we believe can happen.
So you're taking advantage of these market inefficiencies on both sides.
That's right, 100%. So that's where we benefit, and we have this kind of these spidey glasses where we can see under the surface by, God forbid, doing fundamental research and understanding the cash flows, understanding the balance sheet, income statement, et cetera. And with all these turnarounds, the number one analysis you're doing, because they're priced so low and the margin of safety is so high, is you're doing solvency risk. And if you can get comfort that they have enough free cash flow to service their debt, refinance their debt, strong enough balance sheet, then you're just playing the time game until the market recognizes what you do and you give them enough runway to recover. But what's happened in COVID has created so many once in a generation opportunities on a company by company basis. And there are many of them still out there beyond the Magnificent Seven that a lot of money is going to be made by those with enough courage and experience to go a little bit against the grain in the short term. And as we look out, the interesting thing, after the first rate cut, which groups outperform the first 6 months, and no one's positioned for this right now? Value outperforms growth, and small caps outperform large caps.
Interesting. So, I would have guessed the small caps, but not that value outperformed growth.
Yeah. So no one is positioned. Everyone's in the Magnificent Seven right now. It's a little bit crowded. Everyone's short China. And I think what you're going to see, and by the way, international starts to outperform domestic. So as you know, the weighting of China, although it's come down, is still material. So to get that outperformance in international, you'll have to see China start to bid. And you're seeing the government start to panic. I think what they need is a good, kind of protest with a bunch of unemployed 25-year-olds calling for Xi to resign, and then he'll panic and finally do the big bazooka stimulus that everyone's been waiting for, and the thing will be off to the races and never look back. certainly for 2 or 3 years until they hit the demographic cliff. But I think they've got one more parabolic move in China, and then it's over. It's going to be more like Japan. But I think you're going to see a lot of positive things. I mean, the sentiment, the positioning, everything couldn't be more despondent than it is right now. And for most of the highest quality companies, they're still growing free cash flow. They're still growing revenues. And when that recovery hits, they're going to hockey stick.
Yeah, I mean, I've been buying BABA in my long-term portfolio because I'm just looking at the valuation and I'm just like, all right, like, come on, this is like, do I think like China is still the United States' biggest trade partner?
Yeah.
Do I think we're still going to be doing business with China in 10 years? Yes. Okay. So do I think, Alibaba is going to be fine long term? I do. And so it's just so cheap right now. But all right, Tom, we've had you on the line now for about half an hour. Thanks for hopping on. I know we've gone on a little longer than I said I'd keep you. I know you're busy. I got to ask, so I know I want it on the record. What's your handicap? So if we ever play, I know you can't try to sandbag me.
Okay. I started in earnest. We joined the local club here 2 years ago. So
Okay.
I'm a 15-2.
Okay.
And I think that's going to come down though. So
right.
I'm going to be the antithesis of a sandbagger. I mean, my goal this year is to get down under a 10. We'll see if that's possible.
Nice. You do any off season like simulator work?
Yeah. I got a simulator in the house and,
all right. Yeah. All right. You have no excuse to be above a 15 then with a simulator in the house. But
yeah, been getting the putting going. I just got to get the short game in gear, which I think I can do over the next couple of months, and this should be a decent season. We'll see.
Awesome. Well, we've got some beautiful courses up here in Michigan in the summer. If you ever find yourself in the area, then we'll take you out. But Thomas, thank you again. And hopefully we'll get to chat soon. I'll reach back out in a couple months and maybe we can do an updated outlook on the stocks we talked about today.
That'd be great. Thanks so much, Aaron.
Of course. All right, guys, that was.
And we're back. So that gives you a broad look of how I'm thinking about markets right now. I want to thank Ellen Chang for including me on her first article writing for Cheddar News. Was grateful to be part of that, her article about Walmart. So congratulations on the new gig, and thanks for including me. And also want to thank Chibuke Ogu for including me in his article on Reuters earlier this week. Now, as for the general markets, as you heard earlier, we put a 1% equity hedge on last week, Tuesday. Then the market kind of corrected after the CPI, and as it recovered on Thursday, we finished it out. And we'll see how that works. In effect, we hope it doesn't work, because if the market's up another 4 or 5%, we'll probably be up a few more percent with that, with beta. But it does run a long time in through April. And I was reading this note from JP Morgan this morning, thanks to a friend of mine. And they're kind of looking at these measured move areas for the S&P around 5,100 or 5,200. I think we closed at 5,087 in that range today. And they're using some kind of Fibonacci levels. They're talking about momentum rolling over, leadership being thin, et cetera, et cetera, et cetera, which may or may not be true. But what we wanted to do was maintain a full investment and hedge in case we do get that pullback. What's interesting about this, they're saying, let's see here, stalled below 5,099, range measured above, measured move objective. Their measured move objective was 5,099. So that's very close to where we are now. And at we don't expect the rally to extend. Okay, the next notable chart-based resistant level comes in at the 52.19 level. We don't expect the rally to extend that far, but the persistence of the rally, despite the two prior deceleration patterns and thinning of rally leadership in January, has admittedly lowered our confidence level. So these guys have been bearish for a long time. Now they might actually be right temporarily, but what they're looking for is similar to what we are. If in fact we do get some seasonal weakness in the next 2 months, probably the path of least resistance would be back to where we broke out around 4650 on the S&P, called 4600, 4700. That would probably be the most of what we could be looking for, which again, if we get to 51 or 5,200, you're looking in that 5 to 7% pullback range, which would be right in the middle of it. The fact that all of these notable bears who have been bearish since October 2022 have either flipped or found new careers, flipped bullish or found new careers or new jobs, is just from my experience the time when you should expect to pull back. A lot of ultra enthusiasm after the NVIDIA earnings last night. And, extreme can get more extreme, which is why we're fully invested. And it's easy in the type of companies that we invest in because it's easier to discern what is fully valued, what is fair valued. And the good news is we're not near there, so we don't have to be taking off. I mean, the two that I was considering selling calls against because we had such a run from October of 2022 when no one wanted tech were Amazon and Alphabet. Maybe selling some calls, but I thought those are companies I want to own for a while, and if not for a very long while. And probably the better way to dampen volatility was to put that 1% equity capital, and we're pleased that we did. So, as most of you know, we run a concentrated book of 8 to 12 companies at any one point in time. That's usually 85-90% of the portfolio, and then we have a bucket of 10 to 15% of either long dated derivative overlays to get some excess return on our core positions, or opportunistic shorts and hedges where like you saw, we could take as much as 1% on any one short idea, for instance, or hedging idea. And by the way, want to thank everyone. We thanked everyone last week, the new people who came in at the $1 million level. That closed out. And I want to thank a new person coming in well above the minimum. Frank, congratulations on getting started with us, and look forward to many, many years together. Now, they also look at the S&P, pointing to this as a failure. We're going to look at that. I could see a scenario where the S&P stalls out and maybe small caps start to take the realm. The reason we've seen the opposite is after that, for the broadening to really happen, we have to get closer to the cut. Okay, the 93% that have performed, but not at the same level as the narrow leadership, really do need that cut. And the CPI kind of put that in the back seat. I believe we have core PCE tomorrow, which is the key number that the Fed looks at. So that will be interesting if that comes in a little bit weaker or more in line with our longer term expectations and has a lower weight on the owner's equivalent rent / shelter. Maybe this could resume and get the small caps to actually finally break out. And that would give the large caps a little bit of time to breathe, catch their breath, and these take the leadership helm for some time. That would also cause a bid in bonds, which is probably an interesting scenario to be on alert for in coming weeks. If you look at the flows from Bank of America, thanks to my buddy over there, you know who you are. You are seeing some money start to move into value ETFs relative to growth. You are seeing some money start to move into small and mid caps relative to large caps. And the recent inflows into small cap ETFs have been pretty abrupt in the last week or so, couple of weeks. So we should start to see the benefit of that in price action. Here's the S&P 500. So, as you can see, everyone wanted to get bearish right at the new year. I mean, everyone was bearish down at the October lows. You guys remember who were hand-holding through that. Then in January, I said, don't get too cute here. Now we've pushed up so much, and earnings are turning back up, but not to the extent of this push higher. So maybe we do go all the way up to 5,200. It's going to be somewhere between 5,100, 5,200, but I think this has to probably cool in the next 8 weeks, which will create some great opportunities for us. There are huge opportunities already that are not represented in the concentrated companies that are driving this bus. But small caps, just to kind of put a point on what we're talking about here, it's been in this range for quite some time. And here it is. Okay, so it's kind of just waiting to it like break out, snuck back. Now it basically looks like it's retesting this before going higher. And I think that's what I'm looking for on a larger scale before this one can go. I think this is where the excess return we can start to see if maybe we get a weaker inflation or some data that points to they're going to get going by, if not March, May, if not May, latest June, but they are moving in that direction. And the last week and a half, reason you've seen this re-rotation back into the narrow leaders is because those inflation numbers came in hot and people said, wait, I don't know about cuts. But I think that data is seasonally affected. And we covered the non-adjusted data last week and our thought process behind that and moving forward. So as it relates to the S&P, if we're going to see some weakness, which I think we will, then it would probably be back to this level, 465 if you're looking at the SPYs, which again is it will feel like a lot because some names will be down a lot more. It'll feel like less for clients because we have that hedge on, but there'll be a lot of names down 15, 20% just on a if we go up to 5,200 first on a 5% move. So a lot of exciting things happen. I don't love this market timing nonsense, but it just from a lot of experience, I can see inflicting more pain on people who have been skeptical since October 2022. That missed it here, then got bearish again here. Now they've missed it again, and just really forced them to buy in at 5,200 or forced them to buy in NVIDIA at 900 before they hit the trap door. But on the flip side, you don't want to be too cute because we're breaking out of a 2-year consolidation with 0% gains in the S&P 500 up until January. There had been 0 gains. So the measured move on this, if we look further out, 341 to 465, that takes you close to 6,000. Okay. And that's probably something we'll see in the 2025 calendar year, more likely than the 2024. The other thing you have to keep in mind, S&P must be up just under 6% now year to date. These pre-election years have a tendency to be, high single digits, low double digits. So unless we're going to book the whole gain in the next couple of weeks and then grind sideways for 9 months, which I think is unlikely, I think more likely than not, you get all these enthusiastic Johnny-come-latelys, bust them, retest the breakout level, and then don't look back and rip into the year end. And that's the beauty of having the hedge on, because that'll create an extra 5% of equity capital, free money that we can put in some long-dated premium and maybe generate an extra 10, 15 points of alpha for clients, which is exciting. This is the TLT. Again, this is what's caused that re-rotation out of what we saw was that amazing broadness where everything went up into year end when the Fed pivoted. And then bonds peaked, yields compressed, and now yields have been expanding for the last 4 or 5 weeks. And that's why the market looks the way it does. It does look here like it's starting to bottom on the 60 minutes. So maybe there will be some data, if not tomorrow, in coming days or weeks that leads us to get for bonds to get a bid, yields to compress, small caps finally break out, large caps can take a breather, and a nice rotation. The other thing that we look at that we haven't talked about in a while is option skew. So VIX measures the implied volatility of insurance or at the money, and skew, and I'm simplifying it here, measures the implied volatility or the cost of cat insurance or catastrophe insurance, i.e. moves of one standard deviation or more, like big moves. And what you can see here is the demand, and this tends to be the smart money, the demand for cat insurance had been accelerating. And we did explicitly tell you to ignore it last year because it was just coming out of the hole here. And that's kind of normal coming out of the hole like we saw in 2020. And then we got that pullback where it's actually quite a similar pattern here. So if you look at, the lows here, the lows in October 2022, no one was buying the cat insurance. The smart money wasn't buying cat insurance because the house had already burned down, right? Tech was down S&P was down 25%. Tech was down a lot more. The house had already burned down. Smart money had already cashed in their cat insurance. And then as the market rose, more people started to buy cat insurance, similar to 2020. And then what you have is this kind of fake out where the market keeps going up into the fall of 2020. And then everyone's got their cat insurance loaded up. And all of a sudden you get this pullback. Now, this doesn't look like much because the market went straight up for 2 years. And I think we're going to see follow through in the market breaking out of this 2-year consolidation. But you did get some serious volatility. And if I recall, these were 5 to 8% moves. I don't even have to recall. Let me go back and just take a quick look at it. Just because it looks like nothing on the long-term chart, which is why I always tell you to zoom out. So it was 340 down to 310. So yeah, I mean, that was about max. Looks like nothing again, but that was about a 10% pullback, and a little 10% pullback there after, you had almost gone up 75% off the lows in 2020, and then you had these pullbacks. And what I'm seeing now with the skew is a very similar setup where, you had this move off the lows, then this little fake out, and then you start to go down right before you have these little corrections. And I think in this case, it's going to be more subdued, 5 to 8%. But I think sometime in the next 8 weeks, we see it, if not in February, certainly in March or early April. And that'll be enough to scare these people that missed this whole move or this whole move, scare out all the new money, go back and retest the breakout levels, kind of like you saw here, and then resume the uptrend into year end and beyond into 2025 when we start to knock on the door of those 6,000 plus levels on the S&P. But seeing this having peaked out like that doesn't guarantee a correction, but the odds start to favor it when all of the smart bets have been placed. So I would keep that in mind. Other than that, the McClellan summation index of the S&P 500, this one has kind of come off the boil. And what's interesting about this, if you look at a lot of the other instances, this is a good analog here. You're kind of breaking out to new highs, and then you just kind of roll over a little bit and check back before you make your multi-year major rally. It's doing that same type of extreme check back right now, similar to here in 2019, extreme check back, and it doesn't always work perfect, but the odds start to favor. Like this one just coming out, it doesn't look like it worked, but these little moves here in 2013 were like 4 or 5%. And that's all kind of what we're looking for here. It doesn't mean this can't go back up and we go to 5,200, but the odds are starting to favor that. And that's why, while we're fully invested, we have that hedge. Now, as it relates to Cooper Standard stock, we're going to spend a lot of time on Cooper Standard, but I did want to bring up this chart on the 60-day. The problem is this had been a $5 stock for a long time, and our basis is, $5.50 or whatever it is from May of 2022. And then we've added a lot more as new clients have come in the low double digits and mid-teens at the most. And ultimately, at the end of the day, it's not going to matter as this thing works higher. But it hasn't been above $10 long enough to have a tremendous amount of institutional sponsorship yet. So when you get these earnings events, there are no buyers. There's a lot of retail idiots on margin. A lot of weak hands that don't understand the stock and don't understand the cycle. And when, I'd been looking at this gap, and that's why I said in a few calls, it really makes no difference if it goes to 28 or, or craps out and I get to buy some more at 12. So we were able to buy some in the 13s, which is nice. I think we could. I mean, it's hard to say whether we're going to fill this gap or not, because in theory, you filled it here, but do you fill it here in the low 13s or the high 12s? Maybe. This is all nonsense, but it's just something to be aware of. So if you get a 12 handle, you don't need to think the world is ending. Nothing has changed from the initial analysis or the subsequent analysis or the comprehensive analysis we're going to do now. Dividend yield is relatively expensive versus history. This is going to change as the Fed cuts, and this is going to lead a lot of the companies like the Stanley Black & Deckers and the 3Ms and the dividend payers to rip roar as the easing cycle starts to take place. Now, what outperforms the most in the first 6 months following the first Fed cut? And the answer is value outperforms growth in the first 6 months after the first cut, and small cap outperforms large cap. And we believe this time will be no different, and that's what we're positioning for. This is an interesting article from Bloomberg. Temu is shopping like a billionaire with their Super Bowl ads. What could go wrong? And they're basically saying what can go wrong is exactly what goes wrong every single time, which is, it's like, by the way, for those of you journalists from Bloomberg listening, I'm not trying to steal nuclear codes here. I don't need six different ways to log into my subscription. I don't think the fountain of youth is hidden behind your paywall. Just let me log in without clicking on pictures of buses and palm trees and all that nonsense that takes half of my day. But leaving that aside, so basically they draw the analogy to a famous company which was called Wish. Sometime back, it was another cheap retailer selling garbage from China that no one wanted, unlike Alibaba, which sells the higher quality garbage from China that people actually do want, and basically selling below cost to gain share, and eventually they went out of business. It was a high flyer that went to toast, and we'll see if that's the case with Temu/PDD. Rolls-Royce shares jump 8% after 2023 profits more than double. This is interesting. That's why that segment with Charles was so important, as we explained what we did with Intel, which we also did with Rolls-Royce, is that fully valued is fair valued is different than fully valued. So we took off 2/3 of Intel, and Rolls-Royce had been up 3 or 3.5x when we took off 2/3, but we let some run because these things can go much further than you think, and we wanted a free option on the nuclear, and we may hold that for many years to come. And here we go. They did great, and off to the races again, and we still have that meaningful stub to participate. And the same with Intel, you'll see that thing start to fly. But the legacy businesses were fully valued, and if you look at the share count of Rolls-Royce, that was fully valued. Now we start to look at the new Manana plan by the new CEO that he's executing beyond what we would have expected in our conservative valuation when the stock was not fairly valued, not fully valued, but dramatically, ridiculously undervalued based on the emotional weighing machine, emotional voting machine when we purchased it, and we sold it once the weighing machine, the fundamentals kicked in, etc. So that's why we keep a tail. I was telling a new friend this morning that at any point in time, you have 3 choices: sell some, sell all, do nothing. Okay. In the case of Vornado, we got value very, very quickly. And then there becomes a time value of money with a very, very quick double. And we took it all off the table. And now that it's starting to get back into the low 20s, we may have another look at it again because it is a super high quality. And as the cutting starts, REITs are going to pick back up, along with Crown Castle, which is our tower business, etc. So the other thing that's got my spidey sense on is all the people that were skeptical are now upgrading their price targets. Goldman Sachs, UBS. When a European bank starts being the highest target on the street, you know that you're probably in the late part of the stock market move. And now they're the highest target. I think they took it up to 5,400 today. So, it just gets into a little bit of silly season. And I think we're trading at 22 times forward, which I'm perfectly fine with, but probably just needs to take a breather before we resume the rally. This is interesting. One magnificent growth stock to buy before it soars 149%, according to Wall Street analysts. So Morgan Stanley's analyst, James Fawcett, bumped his price target for PayPal up to $145. It's interesting because that's a level where we would start to lay some off. I would imagine at that level, we'd probably take 2/3 off and let a third run on the house. Investors... Okay, so he said fourth quarter week guidance, which we covered the sandbagging 2 weeks ago. Go back and check that out. That's an amazing detailed explanation of what happened on the PayPal earnings call. And he's basically saying there's no upside priced in for the branded business. We agree, and that could be monstrous, and we don't disagree. Now, stock market commentary. Volumes are the name of the game. So moving down here, and by the way, for those of you who have been with us, I know a lot are new. This is kind of a template for the election year. This is from Fundstrat, and you do start to see that weakness come in March and April after the early rally in election years. So we want to just keep an eye on that. It doesn't mean it's going to repeat itself this year, but that's how we're positioned. The other thing that we said in the show notes ahead of those segments is like, yeah, we could pull back to this breakout area again of 46.50, but don't get too damn cute, because you're, after 2 years of no gains, consolidation, the measured move is up well over 6,000. And you can see these years where you had, 1 and 2 year consolidations, when they break out, they keep going. You'll get little back tests after you finally get out of the consolidation range, after you break out. And that's what we think we could be up against in the next couple of months. But then the trend is up. So for the most part, you just hold through that volatility and use any pullbacks to pick up great companies at a reasonable price. The other thing that we didn't get a chance to talk about was that while sentiment is improving among institutions, it's nowhere near extreme, and that's why we think this would be a modest pullback and dips would be bought. Now, Cooper Standard, getting back to the past, present, and future. In May of 2022, we built up a position in Cooper Standard at a basis of around $550. We discussed it on our podcast VideoCast to clients and public viewers alike. On June 7th, we broke our 2022. We broke our Cooper Standard thesis publicly on Fox Business with Liz Clayman for the first time when it was trading around $6 a share. And that's my buddy Phil Flynn over there, who is an energy genius. Check him out. We elaborated on the thesis at a more granular level on our VideoCast episode 138 on June 9th, 2022. You can listen to that. I followed up with this thesis publicly on December 28th, 2022 with Kelly O'Grady. It was up, I think it was up like 30%. It was in the sevens. Then again on July 18th, 2023 on Yahoo Finance. That's after they refinanced. It shot up to the mid-teens. Very important to watch this clip as it relates to expectations moving forward. It will also make the post below make more sense. And what I'm saying here is, in a higher rate environment, used cars are probably being financed out at 8 or 9 or 10%. New cars have the advantage of dealer OEM incentives coming down, and you're seeing them everywhere, 0%, 2% APR, and we're going to see a lot more of that. So the stock's up now 2.8x. The idea emanated from Charlie Munger's purchase of Tenneco during the 2001 to 2003 recession. As Charlie said, quote, "I've read Barron's for 50 years. In 50 years, I found one investment opportunity in Barron's, out of which I made about $80 million for almost no risk. I took the $80 million and gave it to Lilu, who turned it into 400 or 500 million. So I made 500 million out of reading Barron's for 50 years and following one idea. I didn't have a lot of ideas. I didn't find them that easy, but I did pounce on one." So that's Charlie at his annual meeting for the Daily Journal in 2017. And this is around the time he bought Tenneco. And the similarities of the Tenneco, if you look at today's chart, take a look here. It was down from 47 down to $1.20. Same type of thing. They had to refinance $1 billion of debt. And, if you look at Cooper Standard, down from 146 down to 5, same type of thing. They had to refinance the debt. And they made these big bottoms, and then they went straight up. And, little consolidation along the way. And here we are, straight up, some consolidation, and we're going to trend higher over the next couple of years, 2 to 3 years, until we reach fully valued or excessively valued. And we'll sell some at each level. Tenneco is a major supplier of aftermarket auto parts. It is well-known brands include Monroe shock absorbers, Walker mufflers, Dynamax exhaust products. At the time of Charlie Munger's cigar butt investment, Tenneco, which had 40 million shares outstanding, had a market cap of 80 million and an enterprise value of 1.6. By the way, that's not far off. I think we bought Cooper when it was down to like 70 million market cap plus the debt. It probably had an enterprise value 1.1 billion, if I remember correctly. And in Tenneco's case, it had a debt load of 1.52 billion. He bought the stock at $1.50 to $2, so which would be the equivalent. His was down from 40 to $1. Ours was down from 140, so that would be basically he bought it around $5. He sold it at 15, which in our case would be around 60. I think we could get a little higher on average, but we'll sell some before then and some after then, etc. The bonds went back up to par value and were called in by the company in conjunction with a refinancing. Munger turned 10 million into 80, gave 80 to Lilu. Now, this is interesting. He gave 80 to Lilu to invest in China when no one wanted to invest in China in 2003 and early 2004. What is uncanny is how similar Cooper Standard today resembles Tenneco in 2003, 2004, and the Hang Seng Index of 2023 and 2024 resembles the Hang Seng of 2003 and 2004 as well. Both were taking off after periods of uninvestable despondency. So take a look at the Hang Seng. You had this double bottom after a complete disaster slide down. It looks like it had crashed, 70 some odd percent. And that's exactly what we've had in the last couple of years. And now we're doing this double bottom here. And then it went straight up for the next 4 years. And what's interesting is this is not an accident. I'm not just like comparing lines and hoping for the best. There are symptoms in the global economy that create cyclical downturns for auto suppliers that are consistent with setting the stage for cyclical booms in emerging markets in China. So what caused this? You had a period of rising rates, which was detrimental for debt-laden small cap companies. As the Fed started to ease after the tech wreck, that's when you saw them able to get refinanced. When they got refinanced, the thing went straight up. The economy started to recover out of recession into expansion. That's when auto companies do well. Similar situation with 2020 with Cooper Standard. Out of recession, get the refinance straight up and start to recover. And what happens is, as you get a little bit of easing, and most importantly, what was happening here was the strong dollar had started to roll over at the same time as rates compressed. They got the refinancing done. The dollar was weakening, which set the stage for the emerging market move of a lifetime, which the indices at that point went up 4x. The Hang Seng went up 4x or 300% off of those 2003 lows, and individual companies went 5x, 7x, etc. And I believe that's the similar stage that we have right now, where Tenneco, if you look from 2003 through 2007, after they got the refinance, and Charlie admits, by the way, he sold way too early. He sold at 15, the thing went to 35, so he would have had a 35 bagger instead of what was basically an 8 bagger on the debt and equity that he bought. He would have had a 35 bagger on the equity if he held on through the full cycle. I think it's a similar situation with Cooper is going as the dollar weakens and as the Fed starts to cut. That's a favorable environment for a cyclical business like auto suppliers. and you'll see this continue to persist multi-year, probably another 4-year cycle back into over the century mark. In my view, if the execution is delivered, the volumes will come industry-wide, and I think the execution, it has been delivered and will be delivered coming out of this. And the similar market conditions that favor Cooper are also very favorable for China and emerging markets. And for those who feel like this is the never-ending correction from hell in China, which feels like it on a day-to-day basis, this happens every few years. So, it happened in 2015 and 16. It happened in 08 and 09. It happened in 2001 to 2003. That was probably the most comparable, by the way, because it was many, many years, which we've just gone through and put in the double bottom. And that lines up perfectly with what's been happening with Alibaba, which, consolidates for a few years, then has these monster parabolic moves, consolidates, monster parabolic move up. And we've been consolidating for a few years. And once we get through this box monster consolidated move up, I think first stop out, we'll have resistance at 120. But I think once we get out, we're straight to 160 plus, 160 to 180. And I think that's now. It's this year they start easing. The dollar will resume its downtrend that it started, and emerging markets. And that's how the market will counterbalance and offset. So the ones that have been hot can take a breather and either consolidate sideways or just go up less. And then some of these small caps and emerging markets can just pick up the reins and rock and roll. And that's why this chart is so important of value to growth, because a lot of the targets that we have in emerging markets are basically trading at valuations. Same as PayPal trading at a value valuation, Stanley Black & Decker, Generac, you get the dividend stocks, etc., and small caps. So all of that is in place, and we're excited. So now the moral of the story is Munger was able to turn 10 million into $500 million, which is 2 chess moves. Here's some information from our original thesis. So, they do fluid handling systems and sealing systems around the doors and windows. The key point here is, for those of you who are saying, well, what happens when they move into hybrids and EVs? They actually make more money per car with hybrids because there's 28 parts versus in ICs, there's only 8 parts. So they're getting more and more content per car than they did even at their $146 a share peak in 2017. And the industry volumes will recover. So what I have here is what they did at their peak when the stock traded at $146. They were doing $3.61 billion in revenues with about a 12.5% EBITDA margin of 456. And the most important table is the one above with the IHS estimates of global light vehicle production. Key takeaway is volumes are expected to return to 2017 levels by 2024 or 2025. Now, they just put out very conservative estimates industry-wide, and I think they're caught, in 2017, they were coming off a 7-year ramp, so their estimates were very, very high, and everyone was happy. Now, they're coming off recency bias, and they're stuck. And as a matter of fact, last year, their estimates were 4 million units too low, and we're going to go into that in detail. But here's what we basically want to lay out here. What they were able to do in 2017 is $3.6 billion in revenue, $452 of adjusted EBITDA, which is 12.5% of revenues, which translated to $135 million of net income, 3.73% of revenues. And at that time, they had a lot more shares, 18.78 million fully diluted shares. They earned $7.21 a share on that. And on that peak earnings of $7.21, the multiple was 20 times, and they had a $146 stock. Here's what Cooper could achieve in 2024, more likely 2025, as the volumes rise. We think, they sold off their vibration business. I think 3.3 billion of revenues, and that's not a huge stretch considering guidance for next year is 2.8 to 2.9. So like last year, they'll probably exceed that. So, if the volumes tick up a little bit, I think they could do 2.9.5 to 3 this year, which sets them up for 2025 coming in at 3.3 or in that neighborhood, which would yield about $412 million in adjusted EBITDA, which is 12.5% of revenues. Now, keep in mind, they took like $400 million of costs out of the business, so their margins might actually get better once they get over that inflection point where their fixed costs have been met, and then you get all the operating leverage above that. We may see higher margins than expected, like we saw this year, but much more as you get over that inflection, which would be $123 million in net income, 3.73% of revenues on 17.16. I think they issued some shares, performance-based shares. So even if you call it 17.5 million shares, or even if it gets back up to 18, worst case scenario, you're still around $7 a share. And not even putting the peak multiple on, which would take us back to 140. If you put a trough multiple of 10 times when they're earning money, that's a $70 stock. So there's still huge amounts of upsides. And like I said, they've taken out meaningful costs, so the margins may be higher as we inflect. So what's new? Here's the earnings call results. Like PayPal, the results were good on all metrics, but the guidance was conservative. And they said as much in the conference call. So let's look at some of this. Sales were up 3.7% on the quarter. Now, keep in mind, they were shut down for 4 or 5 weeks on the UAW strikes, and they actually quantified that. I think it was 31 million or something like that, which would have blown the doors off of expectations. Instead, they just beat expectations. Gross profit up 19% year on year. Adjusted EBITDA was 27.6 for the quarter. Net cash provided by operating activities was $79.7 million, which improved by $105 million because last year in the fourth quarter they were negative. For the full year, revenues were up around 12%. Gross profit was up 124%. Adjusted EBITDA, which, by the way, look at this. It's at 5.9% of sales. Remember, we're going to get up to 12.5 once the operating leverage kicks in. So was 167 million, which is nearing halfway too. Now, by the way, this increased $129 million year on year, and net cash provided by operating activities was $117 million of operating cash flow, and that improved by $153 million year on year because it was negative the fourth quarter of 2023. So this is the big turnaround year. They were free cash flow positive for the first time, 62 million of free cash flow. A lot of it was made in the most recent quarter, which was also exciting to see. And this is the period where the stock has been largely de-risked, and you make the most money in the shortest period of time over the next 24 to 36 months. We get the extra 3 turns because we were taking risk when it looked darkest. Why? Because we felt that if they couldn't get it refinanced on their own, we could have made some connections for private credit to get it done or be helpful in making introductions to get it refinanced. That's why we were willing to take that risk. But fortunately, they did it all on their own with Goldman Sachs' $80 million of advisory fees. But they did get it done in the worst possible environment in the last 10 years to get it done, which was Q4 of 2022. And the window for them to refinance some of that opens in Q1 of 2025. Even though none of it comes due till 2027, they could refinance at a lower rate in less than a year, which is pretty exciting because rates will likely be lower, as will their presentation in terms of free cash flow and the terms that they'll be able to get. And they'll just be able to keep refinancing lower and lower and lower and lowering that interest cost. Now, what's interesting about, there were 2 big lumpy expenses in Q4 that were one-off. So when people look at the guidance for EBITDA, which was it was like 160 to 182, and they came in at 100 and 167. So they had raised guidance from Q3 to Q4. Then you had the shutdown. But the most important thing is you had a $16 million expense for the pension because they shut down some of the defined benefit. And they had like 40 million of, quote, other. Much of that, I think, in the neighborhood, if I'm guessing here, around 20 million was one-time performance-based comp because they exceeded a lot of performance metrics that wasn't clear that they were going to exceed in 2023. So there was like a 20 some odd million, call it half of other, booked, and you could actually see it, the 20 million bump in SG&A on a year-on-year basis. But they got that because they got paid. So that's not a normalized, neither the 16 nor the 20 are normalized. So if you add that to 167, call it 36, or let's just say, let's say you say, well, they closed the pension, so they had to pay that, so only give credit for half. So let's call it 30 million. The top end of their EBITDA range was like 180. So if you add 30 to 167 on a normalized basis, they crushed the raised EBITDA guidance. And no one's seeing that. They're just saying, oh, why did they come in lower? Oh, maybe it was because of the strike. It was not only the strike impact, it was these huge one-time charges that impacted it in the short term. And they still beat the top line revenues with weeks of shutdown. And you say, well, if the strike hurt them, why didn't it hurt the OEMs? Because they blew the doors off when they reported earnings. And the answer is, it's because the OEMs, GM, Ford, Stellantis, etc., they book sales. Cooper Standard books units produced. So the OEMs had inventories they could sell and book. Cooper only gets what they get to produce. And if their factories, if the OEM factories are shut down, they don't produce. So that was another factor, and they quantified it in the call, which we'll get into. Now, let's go through some of these. We went through cash flow, free cash flow, blah, blah, blah. All that was great. Liquidity, great. Okay, now we can see by region the sales. We can see negative impact of work stoppages initiated by certain labor unions in North America in 2023. So they acknowledge that. Now, why is the stock down? First and foremost, we don't have enough institutional sponsorship yet. The longer it stays above $10, the more those folks will come in, the more execution you get. We're going to see a lot more institutional sponsorship come in. You've already seen Vanguard come back in, BlackRock come back in, etc. You're going to see more of that. But they cannot take up guidance without industry volumes going up. So if the industry volumes, the IHS volumes, are saying volumes are going to be flat, and yet the company is still taking guidance up, which is what they've said in recent calls. Is like they said, we expect industry volumes to grow at X percent per year, but we're going to grow like 500 basis points more than that. Why? Because number one, they're gaining share, they're increasing margin, and they've become a technologically advanced company, meaning they're no longer a Me Too provider. The technology that they provide to their clients is unique and special and helps their clients save costs and increase profitability. And in exchange for that, Cooper Standard gets more money for making their clients more money. I mean, they're basically set up the way I'm set up as an asset manager. I don't get paid anything until my clients get paid first. I don't charge a management fee. I only get a performance fee. And that's a similar setup with these contracts that have improved so much for Cooper Standard. It's not because the kindness of the heart of the OEMs. It's because the net to the OEMs, even paying Cooper Standard more, is less than before because Cooper has enabled them to spend less net money and get a better product and higher profits, even paying Cooper Standard more. So that's evidence of their engineering, technology, and execution. Okay, so even with flat industry volume guidance, they're expecting EBITDA range to go well up, which means that 180 to 210, which means they're going to probably do 200 if volumes are flat. But last year, IHS, which we're going to go into, underestimated car volumes by 4 million units. So if that's the case again this year, that can mean this number is 10% higher on the top line, because if you look, if it comes in at, what do we have here? Well, we'll get to that as we go through. But you can see, just to give you an idea of how conservative management is being in the industry estimates of volumes are, let's look at what they promised last year at this exact time. Conservative guidance last year as well. The company had been too conservative because industry estimates were too conservative, just like this year. Even with an unexpected strike, they still crushed conservative guidance. So they were promising 2.6 to 2.8 billion. They hit 2.82. So just on that, and that's with a strike. So just on that basis, we'd probably be hitting 3 billion this year. They promised 150 to 175 million of EBITDA. They hit 167 again. That's with those, I'm going to call it $35 million of one-time costs. So they'd be at 200 this year, which would imply next year probably at 230, 240. Which means their margins are going to start to go up dramatically, and their free cash flow is going to go up. So their sales were 102 million better than expected. Than the midpoint of the range. Their adjusted EBITDA was 4.6 million better than the middle of the range. Their cash restructuring costs were 23.6 million less than they guided, than the mid range. Their net cash taxes were almost 5 million less than the middle of the range that they expected. And the car production numbers came in 500,000 more than estimated in North America, 1.3 million more than estimated in Europe, 2.3 million more than estimated in Greater China, and 100,000 less than estimated in South America. The industry unit assumptions exceeded by 4 million units last year. Okay. Now, you can see they pulled the exact same under promise, over deliver at this time last year. The stock did not like the conservative guidance, but recovered to new highs as the year wore on. Here's where they gave that conservative guidance, February of 2023. Stock sold off on that. Now, here's what's important. The stock was trading abnormally high in January of 2023 relative to 2022 and 2023 expected fundamentals, and they just refinanced their debt out to 2027 and taken solvency risk off the table in what was a very treacherous closed credit market in Q4 of 2022. The conservative guidance was an excuse for the stock to settle down. This year, we have not run up into the conservative guide. We have simply been grinding sideways, passing time for the next new catalyst, which are higher industry volumes and implementation of higher margin negotiated contracts to arrive, which, by the way, I haven't spent enough time on, because most of that higher margin is going to kick in the back half of 2024, which is not clearly embedded in the EBITDA estimates. Okay, so on that basis, so two things. Number one, you're not coming off of this into the weak guidance. We've basically been pricing that in, so I don't think we're going to have this, 2 months of going down before we start to recover to new highs. I think it'll be sooner than that. But we may fill that gap in the 12s, which would be nice. I'd love to get newer clients a bigger stake. But not only did management dramatically exceed expectations despite the strike, but you can also see that the IHS estimates are 4 million units. On that basis, we could see close to 70 million units in 2024, up from 65.2 million units. And what's interesting about that is 4 million units, they make about $175 a car. And that would be at the that's $680 million of revenues up in the air. So if you assume they're supplying obviously to the big three, let's just say they got a third of that excess unit volume, and the margins are going to be much higher because now they're free cash flow positive, their fixed costs are covered. That could be a surprise $100 million of EBITDA that's not in guidance. And then if we start to get up to the high 200s of adjusted EBITDA, high 300s, now we're knocking on the door one more year to hit 400, which is $7-8 a share. And then it goes multiple, and then we're at a century, and the stock is ripping. So a lot of exciting stuff happening. Here are some of the bridges on their conservative guidance. Ample liquidity, $317 million worth. Plus, they're going to be refinancing in Q1 of 2025. Free cash flow positive inflection. This is everything you want to see in a turnaround. This is the stock-based comp. It was up just on the stock. They had to record another $4 million of cost, $16 million on shutting down that part of the pension. You can see here the selling, general, and administrative up 15 million. So a lot of these were performance-based bonuses, pension, one-off type things. And then the conference call. So sales up 12%, 56 million more in cost savings, 500 basis points improvement in gross margin. That's going to hockey stick next year now that they're free cash flow positive. All 4 segments were profitable at an EBITDA level for the full year. That is the first time they've done that, by the way. All right. Let's just go through some of these. So their adjusted EBITDA was 4.1% of sales. Remember, that's going to go up to 12.5 over the next 2 years, at least in our view, despite the impacts of the strike and the pension settlements. For the full year, sales were 2.8. We probably only need to get to 3.8 or 3.6 to earn $7 a share with the amount of costs that they've run out. Favorable volume mix, new enhanced commercial agreements, etc. EBITDA was 167 compared to 37.9 for the full year. It is actually 190 if you actually back out the one-time cost from Q4. Price adjustments and inflation recoveries. Okay. Here it is. They quantified the strike. They say approximately 31 million in lost sales related to the UAW strike. So that explains the fourth quarter, which was basically well above their raised EBITDA guidance when you add back all this stuff, and significantly above. I think if you add all these things back, you're over $200 million of EBITDA last year, which is just adjusted EBITDA, which is mind-boggling. Okay. Yeah, they acknowledged the compensation, 40 million in other, including higher performance-based compensation year over year. UAW EBITDA impact of the UAW strike was 11 million. So 167 plus 11 puts you at 177. And then you add the comp in, you're at 200. So basically they did 200 million of adjusted EBITDA. The market's pretending they did 150 million. I mean, it's mind-boggling. But that's just because of the composition of shareholders at the moment. That's going to change very, very quickly now that they're cash flow positive. You can go through this, but they're showing how they're no longer a Me Too. The stuff they're delivering to the OEMs at higher prices makes the OEMs more money if they buy commodity stuff at lower prices. And that's what gives them a moat in their business and in their industry. And then the Fortrex Nike deal, which they get, basically they've got no investment. Nike puts this material in their shoes, which is better for them. And for every shoe they sell, they pay them cash. And the more shoes they sell, the more cash they get. And that can just scale globally and be a great new source of income in the coming years that we have modeled in absolutely zero, which could be a lot more than anyone thinks. To growth to outpace. Upside opportunity for Cooper Standard. Okay, this is very important. So what Jeff is trying to say is like, hey, basically we can't give you big guidance because the industry is saying volumes are going to be flat. So how are we going to come out and say we're going to be up 20% when the volumes are flat and we get paid per car? even though we've renegotiated our contracts and cut costs and all that stuff. What he's trying to say is he believes these volumes are too low. And he pointed to something, I've talked about demographics, which point to the most favorable car demographics since the halcyon days in the 90s, because when people move out to the suburbs, they get another car, largest population, 34, prime spending years, et cetera, et cetera, et cetera. But he noted something that I had not thought of before, which is record numbers of new licensed drivers, record high average age of the vehicle fleet in the U.S., light vehicle, which I've pointed out many times, light vehicle inventories that, despite recent improvements, remain well below historic averages. So they've got dealer inventories. All suggest consumer demand for new cars will remain strong and production will have to increase to keep up with these supportive dynamics. I'm increasingly confident that we can and will achieve our longer-term targets of profit margins and return on invested capital, which he said repeatedly, double digits within 2 years, double digits plus. But I pulled up the numbers independently, and what's interesting is our setup is exactly like it was going into 2017. What do I mean by that? It means you had 4 or 5 years of flat new licensed drivers in the US. 2009, 2010, 2011, 2012, 2013, and basically 14. And then it started galloping by, first it went up 1, then it went up 1 million, then it went up 2 million from 2013 to 2014, then it went up 4 million from 2014 to 15, then it went up another almost 4 million from 2015 to 16, and then another 2 million from 2017. So you had basically 4 to 5 years of flat growth coming out of the recession, and then it just galloped. And basically in 3 years, it went up 10 million. Now, what did we have in 2020? The same exact thing. We basically been stuck around this it was 228 before the pandemic, 228 again, the pandemic, 232, 233, and we just had our first big jump of 3 million, 233 to 236. It looks like it's projected we're going to jump another 3 million in 2014 and then another 3 million. So again, what? We're going to jump 10 million in about 3 or 4 years, exactly what happened from 2014 to 2017 when you had this 10 million jump. And here's what happened to the stock at that time when you had the 10 million jump in new licensed drivers. The stock jumped from, boy, this is a long article, $32 to $146. And I think we're on the precipice of that happening again. So you can chase NVIDIA. Maybe it'll double again. I'll take this bad boy and get a multi-bagger with some patience and with a lot more assurity, because I'm not paying 40 or 60 times sales. I'm paying a fraction of sales at the moment. Obviously, the margins are different, et cetera. But this is more bankable than gambling on the future. Now, I'm all for AI. I'm all for that stuff. And we have our different ways to play that, whether through Amazon, through Alphabet, et cetera, through Intel. But these cyclical turns, that's, you don't get 2 chess moves from 10 million to 500 million, 10 million to $500 million in a handful of years in auto parts supplier and China with kind of unpredictable bets. These are as predictable as it gets based on the normal cycle, and that's why we're in them. So let me just cover a couple other things that he went into that are important, and then we'll move on. Clearly, our light vehicle production units and the guidance that we've used for 2024, so you can see there are continue to be a bit conservative, I guess is how I would describe it. I mean, he can't lay this out any clearer. But the good news is we truly have reduced our overall cost base, especially our fixed cost, and we are prepared to make significant margin improvements even on those lower volume. So based on my prepared remarks, you can tell I'm sure that the industry, as we believe there's significant pent-up demand, We believe that many of the other metrics are regarding our consumers and their appetite and interest in buying vehicles going forward continues to be positive. So at some point, we expect volumes to begin to reflect that. But in the meantime, we've chosen to be a bit conservative there ourselves. So he's basically saying, like, again, I can't give you strong guidance without strong industry volumes, but the industry's been wrong by 4 million units last year, which could be 100 to 150 million to our bottom line that we're not guiding on, which is staggering because in a best case scenario, you could see 300 million adjusted EBITDA and like absolutely blow the doors off, which I don't think is outside the realm of possibility. It's not the base case, but some good things can happen. So anyway, this is all opinion, not advice. Go to hedgefundtips.com and see terms. Past performance is no guarantee of future results, et cetera, et cetera, et cetera. You know, I also find it interesting. Yeah, I was doing some segment and they're like, do you own the stock? And I was like, of course I own the stock. Would you ever have someone on this TV talking about a stock that they didn't have confidence to risk their own money? Like, why would you ever listen to someone talk about a stock when they didn't have skin in the game and weren't set to lose or gain with you if they're talking about the benefits of a stock? I've never understood that. Like, why they would ever let someone on TV talk about a stock that they didn't own personally and wouldn't lose money if they were wrong. I mean, it's mind-boggling. But you know, take advice from people with no skin in the game is I guess people do it. But that's the first thing I ever ask anyone with any investment is how much skin do you have in the game if they're asking me to be an investor, and that's the whole key. You know. So anyway, every one of our regions has made a positive EBITDA cash flow contribution to the company. So I think that shows the focus we've had on either exiting because we have or fixing because we certainly have kept them. The Nike deal, this is very simple, guys. I already explained that. They've licensed the chemistry and they make unlimited money as Nike uses it and sells it around the world. Right now, I think it's in 2 sneakers, and that could be a source of revenue that's not in our model. You know, we could wind up having a $1 or $2 per share in earnings that we don't even think is coming, which is exciting. Now, this is also interesting here. Big lump comes this year, and you've been saying this for a while now, that we see the benefits of the restructuring action starting to unfold in 2024. We're starting to see that. He's also implying here you're at the starting point, still having the benefit of those arrangements starting to show up. And he's basically saying, listen, it's very clear what's going to happen. It would be nice to get some more volumes. I'll just leave it at that. Whenever they say I'll just leave it at that is code for like, how clear do I have to be for you to read between the lines between what I'm saying and what I can say and what you need to interpret? I mean, they can't be any clearer in what they're saying. The other thing that they have to be careful about, and you guys have to be mindful, despite the fact that the OEMs are making more net money by paying them more because the technology has gotten better for them. The last thing an auto parts supplier wants to do is brag about how high their margins are when they're negotiating contracts. And that's something that you have to keep in the back of their head. Now, at the same time, what they're providing is indispensable. They're not a Me Too provider. So when no one, here's the way life works. No one cares how much they pay you as long as what they get net is way more than they could get on their own. That's really the secret of life. If you can find solutions for people and deliver value net of your cost that's way greater than the value they could deliver elsewhere, you have a durable, sustainable, moated, amazing business, win-win, providing great value, and that's why you wind up with customers for a lifetime. And that's what we try to do here, and that's what Cooper Standard is doing with these OEMs. But they're not going to, brag and say, wow, look how much money we're making. Because what they're focused on is how much money are we making our clients net of our costs, and we're improving our clients in a way that competition cannot, and therefore they're going to be our clients for life. And that's what they're focused on versus, bragging about how high their margins are and creating an uncomfortable situation when they have to negotiate their adjustments every single year on contracts. So you have to just keep that in mind. If they're conservative and humble, how has that played out in past years when they're conservative and humble? And the answer is they've dramatically exceeded what they said they were going to do. Okay, next, positive free cash flow. If you own this company, you should read this entire article because there's so much here. But if I went, it took me like 6 hours. So like if I went into it, it would take me another 6 hours. But there's so much here. I don't want to skip over what's important. Cash flow generation and continuous improvements. Take care later. We've elected to. Oh, this is interesting. The cash flow generation and our continuous improvement activities to further right-size the business, optimize our financial strength here going forward is going to be adequate from a debt service standpoint. You'll see actually today when we file our 10K later on, we've elected a straight pay on the third lien notes for the June coupon period. So we're confident that cash flows will continue to be strong and we're able to make that decision 6 months in advance. So they have the option to pick the interest, meaning pay in kind, and just add it to the back end of the loan. Instead, 6 months early, they're saying, no, we're going to be able to pay that for cash. The other thing you have to keep in mind, if you didn't notice, they issued a ton of stock, performance-based stock, to operators who have been through hell and back over the last 3 years after this earnings call. And it's probably no accident the guidance was conservative and the stock was down because they were able to issue it at $14 versus $20. And I'm not saying that was necessarily done on purpose. But what I'm saying is that if you want to retain people who have a ton of options at $60 and $70 and $80 a share, who have helped you, been through hell and back with you over the last 3 years, largely to no fault of their own. It was, an industry shutdown with COVID. A good way to do that is give them a decent amount of stock at $14, and that's exactly what they did. So a lot of these guys that have stuck through and helped them turn the company around are going to become excessively wealthy over the next few years, even with a modest stake of 100,000 shares. These guys can make 10, 15 million bucks and be life changing. So that's that. But to your point, the first and third lien non-call provisions come off in Q1 of next year, so there could be opportunities there if the interest rate environment is positive. We continue to execute and have successive cash flow generation patterns out in front of us. Business continues to execute and grow profitably. Again, he alludes to volume. And then double-digit margins, he said, will be there in 2 years. He reemphasizes volume. So he's basically saying the volumes are BS. We're going to knock it out of the park, but apparently you're not hearing me, so I'm going to repeat it one more time without actually saying it, because I don't want my competition to explicitly flag it. But how many different ways can I tell you this, you dumb sell-side analyst? This is what's going to happen. So you can see the back and forth. And then some of the data sales by, you can see their cap table, you can see their sales by regions, you can see their free cash flow. So we put all this stuff in from the 10K. Sentiment, again, a little bit elevated, could get a little more elevated before we get a breather for the general market, but that's that. Defense and aerospace earnings estimates down 3.46%. So I see stuff like this, top 30 weights earnings down. I say, energy, top 30 weights earnings down 8%. So, you see some of this stuff and you say, a handful of stocks here in the last few weeks since the rates blew out a little bit. It's kind of fume short term. And as I said to Aaron, maybe the Max Payne is just grinding sideways, but I think we're getting closer to an asymmetry to a short-term pullback, and that's why we've gone through everything that we've gone through in the last week and a half. Earnings are still growing, and that's why we're constructive, and that's why we are fully invested. Some of the data here, the jobs data was interesting today. Continuing claims were a little lower than expected. Initial claims were 201,000, but again, lower than expected. So that's hot. Let's see. No, I don't think we have core PCE tomorrow. That's rig count. So maybe that's next week. All right. Now, the podcast is over. We're going to continue for those people who wanted me to answer Ask Me Anything questions, which we do every week. Thanks for tuning in. And here we go. Aaron asks, thoughts on JD? JD is super cheap. I think you're going to make money if you buy JD. But I just want to buy the best in class when it comes to China because I'd rather a little more security than I've got enough country and company risk. I mean, JD's cash flow is growing, their revenue is growing. It's decelerating, but I think that stock will probably be fine. Richard Claremont found an impressive company hidden in Alibaba's 13 app. It's one of the non-core assets Alibaba owns a slug of called Momo. I'm sure it's fine, but I wouldn't own it. So the cash flow is starting to reaccelerate. Revenues are decelerating and haven't picked up, so that's worrisome. Let's see here what they do. Just looking at those revenues, though, I'm going to say pass because it was probably a COVID-type business, mobile-based social and entertainment services. Short videos, social. This is the stuff the government doesn't love. It might work. It would be a trade. I'm not interested. Frederick Hammerstrom from Sweden. All right. Thanks for all you do. Thanks for listening. Small investment. Okay. This is funny. How do you evaluate whether there's a risk of bankruptcy? It's you got to assess free cash flow and the ability to service the interest payments. And Nobi is a Nordic housing market, has dropped 80%, resulted in negative cash flows and high leverage. So that probably answers your question. I wouldn't play there. You don't really want to play on the edge unless you can control the outcome, like we could with, we felt we would be able to, worst case scenario with Cooper Standard. So I'll just take a quick look at this. All right, Nobi. Yeah, the revenues have been pretty flat for 10 years. EBITDA started collapsing. No, it didn't start collapsing beforehand, but it was decelerating before the pandemic. What's the free cash flow look like? NOBI. Yeah, I mean, this thing, net debt is going up, free cash flow is going down, revenue is going down. I mean, you're basically playing against the clock. You'd have to really do a lot of diligence on the company and on industry trends and supply and demand and rates and all those things to see how quickly that could turn, how quickly they expect to get free cash flow positive to be able to service the debt. When does the debt come due? What does the cap structure looks like? What will they be paying when they refinance it, if they can refinance it? So I think you're in a hairball there. I'd put that in the too hard box and go for something easier. But thank you for sharing with your friends, and congratulations on your small investment circle called Baba and Beers in my honor. I'm very grateful for that. Maybe one day I'll be in Sweden and I will come celebrate Baba with some beers a year or two out, which would be exciting. Can you recommend any energy-related books to learn more about the sector? Sam, I think the key thing is the number one thing you can do to educate yourself on a sector is read tons of annual reports on tons of different companies. I also like to go to kind of the genesis of a sector. So, like, obviously, I liked the book Titan about John Rockefeller. I like the book Wildcatters, the story of Texans, oil, and money. Monty Moncrief, Texas oil billionaire. I like to see what they went through. Obviously, learned the story quite a bit of Jerry Jones before we got in Comstock, which is now, at point of maximum despondency, starting to turn now, as we anticipated with the seasonality of natural gas. Probably have one more flush out, and then we can start to move. And we've used these opportunities of softness to add more. So I hope that's helpful, Sam. Rohan Joshi. Tom, thanks for sharing your knowledge. Have you looked at Goodyear Tire? Similar to VF Corp, they have a new CFO in place. CEO, would appreciate your thoughts. I've looked at the car companies many times over the year. The tire companies, it's too competitive because of all the Koreans. I don't like it. And the Japanese and the Chinese selling tires. That game changed. It does look like they're inflecting here to cash flow positive, and you maybe do it for a trade, but it's a low return on capital, low quality business, and never seems to get out of its way. But that doesn't mean it won't double in the next year. So have at it if you're comfortable with the balance sheet and free cash flow. Jason Zen, Cooper Standard questions. We covered everything you need to know about Cooper Standard. Thanks for the question. Trying to get heavier into energy and grid infrastructure. I know you have some energy plays like Comstock and also like CCI. CCI's towers. Any other ones you're looking at that will benefit from the 300 to 500 billion being spent by the government over the next 5 to 7 years? How about literal picks and shovels in Stanley Black & Decker that sells all the tools to all the infrastructure that's going to be done over the next 3 to 5 years from the Inflation Reduction Act? Craftsman, DeWalt, Stanley, you name it, they make the tools. They're going to benefit. Generac is going to be backing up all of those sites. That's going to be a big boon. What else do we have? 3M is going to be a beneficiary of that. All the names we've covered. We're positioned for that. Mark Hill, great show. Love the insight you provide. Could you comment on Merck? PE appears difficult to sustain. Yeah, this thing's had a nice run. I mean, it's hitting on. I mean, would I ever buy this with new money right here? Absolutely not. If I owned it, would I be a seller of it? What are they paying you to wait? You got a 2.4% dividend yield on your basis. It's probably 5%, I would guess. What's the earnings look like? Earnings are coming down a little bit, but it's trading at 13 times. I don't think you get hurt with Merck. I wouldn't be a buyer here, but I think long term you're fine. I think short term it's probably gotten ahead of itself, and yeah, I mean revenues are starting to accelerate. There must be an acquisition in there. So 13 times. It's historically traded around 14. So it's at the top end of its range. But again, if you're holding it long term, you're okay. It might pull back in the short term. If you're just getting in, I think it's ahead of itself. JT, another question on CPS. We've answered that. So with that said, I'm going to thank everyone for joining. We'll be back next week, same time, same place. In the meantime, make it a great one. Bye for now.